Hello, everyone. Welcome back to On the Brink. Thanks for joining us again. Today we sit down with Kyle Samani, co-founder and managing partner at Multicoin Capital. Most of you, or all of you, will be familiar with Kyle. Certainly, he said things I've disagreed with about Bitcoin, and I'm sure the converse is also true. But agreeing with us is not a precondition for appearing on this podcast. Quite the contrary. We welcome spirited debate. Today we hit a number of topics. We start with Kyle's current outlook for Bitcoin and Ethereum and their near-term prospects. We look back at the calls that Kyle is most proud of and some of the mistakes he's made. And we look back at Multicoin's EOS position and their thinking behind that. Then we move on to Web3, which is really the subject of today's episode, what Web3 actually means to Kyle, how he defines it, and how near we are to Web3 becoming a potentially consumer grade and functional phenomenon, and what the near-term breakout applications might be. We also look at whether Web3 requires Ethereum to work or whether its future lies with other chains, and Ethereum's relationship with the Web3 thesis and how that's changed over time. I want to thank Kyle for coming on. Let's dive right into it.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin. Bitcoin.
Kyle Samani, thanks so much for coming on. Welcome to the show.
Nick, good to be on. Long-time listener. Good to be here on the show.
I love to hear it. We've butted heads a few times over the years.
Just a couple.
We don't see it eye to eye on everything, or even maybe like a majority of things. But, that's crypto. So we have a lot to talk about. The main general topic for discussion is the concept known as Web3. But before we do that, you always have like interesting and contrarian opinions on Bitcoin and Ethereum. So I wanted just to get your view on, not like price-wise per se, but where you see Bitcoin and maybe also Ethereum in terms of their positioning and their general prospects as networks, especially as a lot of these newer protocols come online.
Yeah, so very fun question. And let's start off with the most polarizing tribal question, just to make this a fun interview.
We'll throw you in the deep end first thing.
Let's do it. So I think it's actually easier to start with Ethereum than Bitcoin. So Ethereum, like, I want to love it. And like Ethereum is what made me fall in love with crypto. I never had like strong like libertarian views or had strong like opinions about monetary policy and government, printing money and all those things. So Bitcoin kind of never appealed to me. But Ethereum did as this like development platform to do cool things. And as it became increasingly clear that like financial applications were going to matter, like it was very clear to me early on that smart contracts were going to be a very important thing for like the future of money and finance. I've become somewhat disillusioned with Ethereum over the last probably 18 months, just because like I disagree with a lot of like the kind of long-term technical decisions that have been made in terms of how we're actually going to scale this thing to be meaningful in terms of users and dollars. Although the dollars on Ethereum today are somewhat significant. I mean, like 10 billion of TVL, and, there's like call it $3 or $4 billion of loans outstanding. I mean, like these are real numbers now. The number of actual users is almost zero. I think the best way to think about that is look at the Uniswap airdrop. There were 250,000 addresses that received Uni tokens from the airdrop. So that tells you that like no more than 100,000 people have ever used DeFi. Right? Like I personally have like 4 addresses that got those tokens. I'm guessing you probably have 1, 2, 3 yourself, right? Like it's hard for this math to get over 100,000 users. And so, and I look at like gas fees and everything, and like, it's just like, it's just like, we're so many orders of magnitude away in terms of scaling that like, I've become very disillusioned with how the current Ethereum roadmap is going to get us there. And I've developed a lot more conviction that the network effects are not insurmountable because the number of absolute users is so small. and B, that like there are much fundamentally better architectures. And I've come to believe both of those things with pretty high conviction.
So your point is that given that it's at most a couple 100,000 users that are totally taking advantage of all of the block space available and just plumbing all the network's resources and kind of reaching exhaustion almost, if you look at fees, that requires really significant scaling to support more users.
Yeah, I mean, I think for these systems to really work as we really, really want them to at global scale, we're off by right now about 1 million X. Like we're not off by 10 or 100X. We're off by 1 million X. And if you think about it in that lens, like you have to completely throw away all conceptions of like what is the current performance and like any notion of tweaking the current architecture. And you have to go back to the basics and just say like, okay, how do we just compute more stuff faster? And I don't think the kind of current propositions being discussed are getting you anywhere even close to 1 million X.
So I guess you could say we have to throw out incrementalism and start being more revolutionary in how we think about these networks.
Specifically in how to scale computation, yes.
Now, I feel like your views on Bitcoin have maybe moderated a little bit. I don't know if that's just me speaking optimistically. What's been your personal history in terms of your view of Bitcoin and like where does it stand today?
Yeah, so I've definitely gone back and forth on Bitcoin from like being a full smart contract kind of believer to like losing a little faith in smart contracts and now kind of appreciating Bitcoin for what the simplicity of what it provides. The more I think about Bitcoin, the more I think that like the fundamentally interesting question for Bitcoin is like, what's going to happen and call it like 5 years or so from now when like you've got some sovereign wealth funds or pension funds or whatever, and they're like, okay, like we're going to finally buy these non-sovereign money things, whether it's Bitcoin or Ethereum or whatever new layer one it is. Because it has some cryptographic properties and some monetary properties. Of all of those options that are available, then let's say there's going to be 3 or 4, I don't know, potentially like main, real competitors. Bitcoin is almost certain to have the strongest Lindy effect in terms of just like it's the oldest, right? Like proof of work's been around the longest. It'll obviously have those properties. It'll probably have the hardest, most simplistic monetary policy of all of these things. But like, is it going to be a 10x better in those fronts, or is it going to be like 15% better in those fronts? And I think it's going to be closer to 15% than 10x. And so if you kind of assume that's what that's going to look like, which I think is actually a pretty reasonable assumption. And then you also think like, hey, are one or multiple of these smart contract platform things going to be facilitating trillions of dollars of trading and commerce and whatever, all these fun bang, widgets and stuff. Like at some point, if you're the no coiner in 2025 or 2028, who's got to deploy $1 trillion or, about $100 billion into these things, like where do you put your money, right? And why? And today it feels very easy to say Bitcoin is the only answer. And like, I agree today that like, it's clearly a much better answer. But when smart contract platform X or Y is, trading that kind of volume, that's a lot less clear because again, you're getting the same cryptographic properties and you're getting almost all the same monetary properties.
What do you make of the injection of Bitcoins into Ethereum with the whole wrapped Bitcoin phenomenon? Does that, like some people have said that, is kind of demonetizing Ethereum on its own chain by putting, this different monetary asset in there. So weirdly, it's to the detriment of Bitcoin. And then there's obviously the talking point about, well, Bitcoin can't even support the conveyance of its own units, and so it demonstrates Bitcoin's obsolescence as like a technical protocol. Or is it just completely irrelevant? What's your attitude to that?
Yeah. So again, if you believe that monetary policy is binary and like either it's Bitcoin fixed supply, set in stone 10 years ago and has never been modified, right? Like if you're going to take the pretty extremist stance on monetary policy, then Bitcoin being on Ethereum is good for Bitcoin and bad for Ethereum because Ethereum's monetary policy is obviously not as strict as Bitcoin's. I'm not saying strictness is good, but it's just clearly not as strict. And that's not really a question. And the same is going to be true for any of the other smart contract platforms as well. Like they have more governance and like they're newer and more people yelling at each other. And so there's like their monetary properties are not as good. But now if you look at the other way around and say, monetary policy maximalism and like the strict fixed supply thing is not binary and like it's a feature but not necessarily the only feature, then I think it kind of lends itself to the other argument, which is Bitcoin can't even support itself. It's just going to end up somewhere else, and ultimately the other thing over there is going to be more valuable. I tend to lean towards the latter view more than the former. It's okay to be off by 1 or 2 or 3 or even 5% in terms of monetary policy. Like you don't need that level of precision to like provide the world the order that it needs.
What would you say like the single biggest like reversal you've had in terms of your attitude to the industry has been? Something you believed was true, which you subsequently realized was not the case?
Ooh. I'd say this is a piece of advice I share with all of our portfolio CEOs, which is that the most important feature of a token is its market cap. And I don't mean that in the like I want to make money as an investor kind of a way. I mean that in the social legitimacy that having a high market cap provides. It still to this day perplexes me how Chainlink has a $10 billion market cap. Like I don't know who owns all these things. Same with Litecoin. Like pick many other assets in the top 10. Like I cannot explain to you where those dollars are, but like I know they're real dollars. Like somehow somewhere they're real. But I've also realized that like the social legitimacy of being higher on CoinMarketCap is real. People take things seriously because they're higher on CoinMarketCap and CoinGecko and Binance and all those other things. And that is immensely powerful and underrated. What we really emphasize that to our portfolio companies is like, you need to be higher on CoinMarketCap. It makes you real.
That's interesting. I find myself realizing that a lot of my committed beliefs about this industry end up just being false over time, which I guess is a kind of a flexibility you have to have any longevity in the industry. I mean, I would say I've noticed from you a certain amount of flexibility, or at least like a open-mindedness, like willing to explore new concepts pretty aggressively.
One really big mistake I made early on was I got into Ethereum because of the ideological belief in the power of decentralization and like openness and like, absorbing, I'll call it the Bitcoin Ethereum view that like the primary metric of decentralization that matters is node count. And the longer I've spent in this space, the more I've realized that is too simplistic, and that also that view is a manifestation of an ideology that may have been necessary to get crypto off the ground, but doesn't mean that it has to be necessary for crypto to continue to move forward from where it is today. And I'm increasingly of the view that at this point, every libertarian on the planet owns Bitcoin. Like you can't really be a libertarian and like not have heard of Bitcoin and not like wanted to buy it. Like all the ideological buyers for these things have been exhausted. And so we have to get to the next 10x of growth in market cap, we need buyers who are not ideologically driven. Whether that's open finance or whether that's like open software building on a decentralized network or whatever, or just libertarianism, you need market-driven, utilitarian-driven buyers. And so I think in a lot of ways, the strong ideological beliefs that are the basis for many of these networks are increasingly hindering them.
One thing I remember from one of your old blog posts was this effort to create sincere, real valuations of certain tokens. Like I remember an Augur one where you looked at the cash flows that might accrue to Augur and, endeavored to devise a valuation of that one. And it's kind of like an early attempt to view certain classes of tokens as like capital assets. I know this is something that has been hotly debated over the years. And I would say today it's interesting that there is like a whole genre of tokens that explicitly have cash flows accruing to them. And there's actually, a few dozen that have maybe fairly material cash flows or at least burns. What do you make of this new kind of class of DeFi tokens with cash flows? I mean, I see people applying like price earnings analysis to them, and you look even comparing those multiples to like public equity. Do you think that's legitimate? Does this kind of like vindicate that attitude of yours, or do you find that analysis questionable?
Yeah, I mean, something that has cash flows of form is like you can run a DCF and identify the yield, and people can play a cost of capital game on if they think the asset's overvalued or undervalued. I believe like that is like a fundamental law of finance. I don't see a way around it. So I'm excited to see a lot of those capital assets, starting to do the things that they said they were going to do. The DeFi community today tends to exaggerate what a lot of those ratios are in pretty intellectually dishonest ways. But like they are starting to accrue. I think the biggest actually open question for most of these DeFi things is long-term value capture. I've been kind of poking at this debate online, and I usually get kind of yelled at when I bring it up. But it's not clear why Uniswap needs to have a token, or why Balancer or those kinds of things. 0x, we kind of already went through this like life cycle of debate, and right. And I have a blog post I started working on a couple days ago. I'll give the sneak peek preview here on Castle Island podcast. But basically, my theory for the framework I've come up with on how to think about which DeFi tokens can actually capture value are the ones where the token actually has to manage risk in the system. So like the easy way to think about that is like Maker versus Uniswap. In Maker, like MKR holders are the equity backstop of the system in a very real way. But in Uniswap, there's just a tax on the system. And it's not really clear that like there's a way to evolve that Uniswap protocol in such a way that there's actually any fundamental risk in the system. If you look at Compound or Aave, like those again, like have clear notions of fundamental risk in the system. Look at so that's kind of the framework I've been thinking about. I think it's intellectually coherent. I think it makes sense, right? Which is just like, look, like if you are the final backstop in the event of some liquidations or some assets, whatever, like being stolen out of a vault or I don't know what, but like if you are fundamentally backstopping the system, you are effectively the bottom of the capital stack. And that therefore you have a right to cash flows out of the system, and like you can price that risk. Like I believe that view is coherent, and I think we'll start to see the market get there over the next couple of years.
So I guess to synthesize that, your point is that if you as a maker holder are constantly bearing that risk of dilution because there's some insolvency in the system, you're more incentivized to make good decisions and participate in governance. And so in theory, that leads to a healthier system overall. Yes,
correct. And in exchange for bearing that risk, like, people who want to obviously DAI creators, right? They have to pay for the cost of leverage, right? You have to pay to borrow money. And so like you are justified as an MKR holder of receiving cash flows.
One last one before we get to Web3. So like obviously you write a lot, and I think that's something people associate with you is a willingness to cover a huge diversity of topics. What of your historical pieces are you kind of happiest with and you think has aged well? And then conversely, what's one that you kind of wish you could bury in the ashes of history?
So the one I want to bury is easy. That's the long EOS paper we wrote in April of 2018. We were just wrong. We just totally missed the mark on that one. We had a bunch of theories. Most of those theories were just plain wrong. We've been laughed at plenty of times for it. We lost plenty of money on EOS. We moved on, and it is what it is. But the paper is still on our website. If you dig at Multicoin Capital, EOS, you'll find it. We have not taken it down.
Just on that one, have you done a retrospective on EOS at all, like on any podcast?
Not on any podcast. Internally, we do a quarterly decision review where we look at kind of decisions over the last 3 and 6 month periods and figure out what we did right and wrong. So we have a lot of internal, grief and learning, but not in a public setting.
So I don't know, maybe just briefly, are there bullets of what places you identified where you went wrong, or is it just one of those things that you took a swing and you missed?
So I'd say the most hidden thing that was very non-obvious, but that I have a deep appreciation for, is, and that actually really shaped my views on Ethereum and DeFi, was the correlation between price and transaction usage. So one theory we had was, if you look at the Ethereum transaction gas consumption chart over the course of the second half of 17 and first half of 18, it's generally trending up and to the right. Our view was that basically the system by basically June or July of 2018 was going to become saturated, like 90% plus gas consumption. And we were pretty convicted that was going to be the case. And prices started kind of going down after April, May or so, and never kind of recovered from there. You just went into it just got very apathetic in the market, and gas consumption started to fall. And we thought that the gas consumption gas prices were going to cause people to force to basically look at EOS, because EOS was launching in June of 18.
I see.
And we were ultimately right about the thesis. If you look at what's happening now, that's literally what's happening. But we didn't appreciate the power of the correlation between price and gas consumption.
That's really, really interesting. Okay, so now here's your opportunity to say the blog that you're proudest of.
The blog post that I am the proudest of. I'm going to go with the one I wrote about 6 months ago. It's called On Forking DeFi Protocols. And everyone was talking about DeFi, all the Ethereum maximalists, latter part of 2019 and first few months of this year. And you could feel the bubblings in social media. And I was very well aware of what was going on. And I'm an avid snowboarder, and whenever I go on I like going on solo trips. I'll just shred all day. And what I'll do usually on those trips is listen to podcasts on the way up and music on the way down. And I have a lot of time to think. And I listen to literally 15 DeFi founders over the course of 2 weekends. And so a bunch of stuff is just bubbling through my head. And as a result of that, I wrote, I consolidated all my thoughts on DeFi into that forking protocol and that forking piece. And if you look at it now, 6 months later, the funny thing is when I wrote that, all the DeFi people were throwing tomatoes at me, being no, these things are so defensible and whatever. And the funny thing is actually I was off by an order of magnitude of how undefensible most of them are, and how easy it is to fork them. And what I realized is latent capital is so plentiful and so fickle that the forkability and defensibility in these things is quite low. And I think a year or two from now we're going to look back on that post, and I think it's going to have directionally nailed everything, and it tried to directionally cover 7 or 8 different things. And although I think the order of magnitude of each of them is wrong, I think directionally all of them were correct. And so I'm looking forward to reviewing that post in another year or two.
I'll put it in the show notes. All right, so let's dive into Web3. I mean, so admittedly, Web3 isn't something I've ever spent a huge amount of time on, maybe kind of shamefully. But you guys invest in it a lot and you talk about it a lot. So I figured you could give me the description. How would you actually describe Web3 as a concept? Because it's been described in really nebulous ways. So what's your kind of favorite description for the phenomenon?
So I'll give you a both more and less nebulous description. So I think of the Web3 maximalist type people, those folks tend to talk about data sovereignty and data ownership and don't being subject to Google and Apple and Twitter and Facebook and those people. And I think that's one potentially interesting outcome of Web3 in some distant future state of the world. But that's pretty far away and we're not even close to that stuff. I think the more interesting way to think about Web3, which is also a little bit more nebulous, is just the foundation to create trust minimized applications. And so the largest class of trust minimized applications today are DeFi applications. But there's lots of other trust minimized applications. Things like Helium, for example, things like Audius, things like Oxio, a whole bunch of others. All of these things share some common properties and underpinnings with DeFi and with Bitcoin. But then they also have kind of new, unique things as well, enabling them. But the core of all of these things is facilitating trust minimized economic value transfer between two parties in some way.
One thing I've noticed is kind of maybe a disillusionment with the concept of Web3. Since, I feel like it was really, really big in 2017, and it was kind of a very integral part of the Ethereum story. And then today, the Ethereum story is a little different, and it's kind of more narrowly lionizing DeFi with some of the non-financial use cases being marginalized a little bit. Where do you feel Web3 is in terms of its development based on where you expected it to be, 3 or 4 years ago?
Relative to 4 years ago, I'd say it hasn't come as far as I expected. Relative to 18 months ago, it's in line. I've come to the realization that the most common expression of the Web3 thing by the kind of Web3 ideologues is, again, like the own your own data, self-sovereign internet applications. And that stuff is just, we are still very, very far away from that, like not even close. And so I'm just like less interested there, but I also like think that's okay. And there are now some things that are possible that I am pretty excited about. And I think we're going to see a lot more of those things rise to prominence over the next 12 to 24 months. And I think they'll get probably undeserved media attention because they're basically the first ones that work. Like you could argue
Right.
DeFi has received undeserved media attention. Like, right, Coinbase is 30 million registered users. Binance is somewhere in that neighborhood. Binance is definitely more than 1 million daily active users. And like we know DeFi has no more than 100,000 total users ever. And so like just right, like DeFi has received undue media coverage because it's just like the new thing. And I expect this kind of first wave of new Web3 things to also receive undue media coverage simply because they're first.
So if you're pitching Web3 to a complete skeptic, what would be the applications that you would call out to them as the most kind of immediately addressable and relevant ones?
Yeah, the first one I would call out just for like a mass market consumer audience would be Audius.
Okay, so let's dig into Audius a little bit. So tell us a little bit about it. You described it on our call as sensor-resistant SoundCloud. What does that mean? What's kind of the purpose? What's the reason for existence?
Yeah, so full disclosure, we are an investor in Audius. We've invested a few months ago. Audius is decentralized music streaming. The primary property of that you receive is censorship resistance. And so the idea is, the goal of Audius is not to compete with Spotify or Apple Music. So like, just kind of get rid of that mental framing. The kind of immediate priority for Audius is kind of two major segments of target users. One are like DJs and like hip hop artists and those kinds of people who want to remix other people's music. They want to be able to do so and republish and broadcast to the world. For anyone who remembers SoundCloud, like SoundCloud kind of had its heyday from 2010 to 2014 or so, and has become meaningfully less relevant in terms of like broad-based social culture since then. Basically, the top of SoundCloud was when the record labels all came in and said, "Hey, all of the stuff on here is remixed, copyrighted content. Like you have to take it all down." And so that happened, and that basically killed kind of I'll call it the ideological fan base that comprised SoundCloud, and most of those creators went elsewhere and tried to distribute elsewhere and have been largely suffocated. YouTube obviously does something similar, and Spotify obviously does something similar, and so that kind of, I'll call it the underground of like new creative music types, has been largely squashed by record labels who have been able to dictate terms over centralized platforms. The goal with Audius then, kind of target user base number one, are all those people who want to kind of unlock that creativity of music by recomposing in different ways. And then the second major use case for Audius are people who want to be able to stream audio into games, social environments, whatever, but in some sort of automated software application, and they don't want to deal with copyright issues as the game developer themselves. And so actually, there's like, I think 5 or 6 games that recently started using the Audius API, which launched like, 6 weeks ago. And those game developers, like, the great thing is they can clean their hands and say, look, we're not streaming audio, right? Like it's coming directly from audio servers to users. And they don't have to worry about copyright issues for their games, which actually for like a long tail of game developers and other types of comparable things is actually a pretty big deal. And
so Audius is not trying to comply with the DMCA, right? I mean, that's not an objective.
So I mean, Audius, so you have to understand, Audius is a protocol. Audius is not a company. Audius protocol leverages IPFS. It kind of has it's not a fork of IPFS, but it kind of wraps IPFS with some other stuff. and then anyone in the world can run an Audius node, just like Bitcoin or Ethereum or any of these other things. And when they run an Audius node, obviously these things all find each other and connect to each other. There is an Audius front-end application to browse music and have a profile and share with your friends and do all those things. The Audius open source, the front end is open source. Every line is open. You can take it today and fork it. Actually, I think the first couple developers have started to fork the Audius front end now and do other stuff. And obviously the Audius front end system will find Audius nodes and stream music from them, right? But Audius, the team that built all of this, is just a team. They have no revenue. They don't intend to have any revenue. They don't host any files. Like, they just publish open source software.
What is the information that goes on chain, so to speak?
Yeah, so there will eventually be payment flows in the Audius system. Today, there's no payment flows in any form. But you can imagine, like, people may want to say, hey, look, if you recompose my music and you get 1 million listens, please pay me, X dollars or whatever. So the Audius protocol will be adding payment type of features in 2021. So that will obviously live on chain. And then the other major class of thing that will live on chain, this actually lives on chain already, is basically your social profile. So whenever you open up the Audius client, you sign in with Twitter, and whenever you like a song, repost a song, play a song, share a song, do all those things, those obviously all get tagged to your public key, which lives on the blockchain. And that is used then for recommendation algorithms and all those kinds of things. So all that lives on chain. And what that means, though, is that because all that data is on chain, that means if anyone else wants to create a new Audius client with new recommendation algorithms, or then like they can have new algorithms on top of the same open data set. And
I presume Audius has a native token, right?
Correct. Yes.
So I guess the existential question is why do it that way? And maybe you can get into the token economics a little bit, but as opposed to create, an interface for a P2P, music streaming app. And then if to the extent that there's monetization or direct payment to the artists, use something like an established stable coin or something like that.
Yeah. So the Audius token is not a medium of exchange. The Audius token has a couple of functions. One is, I think once payment features are implemented, I think it's likely that there will be some sort of fee payment to the Audius nodes for hosting all the audio and streaming it all and stuff. So there's some kind of capital asset angle there. And then the other one, and this is actually the more interesting one, is dispute resolution. So the Audius system is obviously permissionless. I could today just download a whole bunch of MP3s of Taylor Swift music and upload all of them to Audius. And I could create a profile on there and say, I am Taylor Swift, and then try and claim credit for those, write those songs saying that they're mine. Once payment flows turn on, you can imagine that's very problematic. And so you need some sort of way for basically people to verify their identity and say, look, this Twitter profile actually belongs to the artist they say it belongs to. And then you also need to be able to way to say, look, this artist who owns this Twitter profile did in fact publish the song, and any payment rights need to actually flow to the underlying person. And so you need some sort of decentralized way to solve that problem. And so the Audius token will be kind of the Sybil resistance or part of the Sybil resistance to solve that problem. The exact mechanics of how it's going to work are still unclear, but if this is ever going to actually matter, you have to have some way to solve that problem.
I'm presuming this isn't the first kind of media streaming on-chain project. I feel like I've seen some of these as well.
There have been a few others. There was a thing called library credits. I know it came around in 2017.
Yeah, that's Jeremy Coffin. I think that's a Boston-based project.
I don't know whatever happened to them. I know it was supposed to be decentralized YouTube, but I don't know what happened to them. There was DLive, which we spoke to them for a while, about a year ago, fundraising, and ultimately ultimately Tron acquired them.
Right.
So I know they have some users. I don't remember what the blockchain part was for. Then you've got LivePeer, which we are an investor in, and those guys aren't really focused on the user interface platform, but on kind of a new way to connect people with GPUs to people who need to transcode videos. And so there have been a handful of teams playing around with this kind of a thing. Audius is probably the most ambitious and I'd say well-funded effort with just like a very comprehensive team that they have real traction now. I think there's something like 600,000 monthly actives on Audius, and they should clear 1 million by the end of the year.
So you described them as the first kind of on-chain music streaming platform with meaningful usage.
Yeah, that's correct. I use Audius now probably every 2 or 3 days. I listen to Audius. They have good curated playlists on there. It's still early. Like this is not going to replace Spotify for anybody. But for the folks who are into kind of like long tail music discovery, there's a pretty vibrant Audius community now today around that.
So what I think it was Larry Sukanik that coined this, something about, the difference between sovereign grade sensor resistance, and I don't remember what the other one was, platform grade or something. And this would probably be in the latter category, right? Like you're not trying to ward off attacks from the state, but you're trying to generate enough decentralization such that it's difficult for legal attacks to work.
That is correct. Yeah. The other thing worth noting is that the DMCA, which is kind of the Digital Millennium Copyright Act, the way it actually works, there is no federal agency responsible for enforcing it. The way that the DMCA works is if you own copyright to some piece of music and you identify someone on the internet who you believe is violating your copyright, you can send them a takedown notice. They have like 24 hours or 48 hours or something to comply. And then basically if they don't, then there's kind of a series of enumerations, which ultimately end up in suing them in federal court. But there's no like enforcement agency, right? And so as you imagine, you like start escalating through the kind of the series of steps here. When the servers hosting all the content are not in the United States, it quickly becomes exponentially more difficult to enforce any of this stuff.
So there's no obvious person to sue in this instance.
Correct. And in fact, there are lots of hosting data centers around the world, not in the US, but not in the US, that actually publicly advertise to developers like, look, like we do not comply with DMC takedown requests and other analogous types of requests.
So the return of the premise, you're pitching Web3 to a complete outsider. What would be another application where you'd say this is kind of immediately relevant and works today?
Yeah, so I mean, the other one that we're really excited about is called Helium, which we invested in about 1.5 years ago. And Helium is a new way to think about deploying a wireless network. So today, you've got AT&T or Verizon or whatever you got. If you think about like how do you deploy a wireless network, you can imagine there's a group of people. They sit in a room somewhere. They look at a map of the city. They say, we want to put towers in all these different locations. They call up the people who own the land. They negotiate with them, rent some land. Then they go hire a bunch of guys with hard hats, have them drive around, install a bunch of towers, run a bunch of backhaul, right? Like do all that work. That's obviously very capitally intensive. Then they build massive marketing arms and agencies, massive sales and retail arms and customer service departments, right? And then like just then fund it all by a bunch of debt, and then collect a bunch of subscription revenue, right? And amortize the cost of CapEx over like 10 years or whatever it is. And that's kind of like the general model for like deploying a wireless network. One of the key challenges with a wireless network is that if you don't have, a large area of coverage, people basically don't want to use the service because like people travel, right? And drive around and fly. And so people expect to have coverage everywhere they go. And so having small regional sectors of coverage is very difficult. So the Helium team has had this vision for a long time of basically saying, look, like we want to have sensors all over the world that can like pick up things. Is the grass watered? Are the trash cans filled? Do we need to send someone out to take out the trash cans? Is a car parked here in this parking spot? We're tracking GPS like items through the world. If you think about agriculture, like, hey, is the ground, getting enough water in all these different places? Fire sensors, all these kinds of things. But there's all kinds of things in the world you may want to detect and have some sensor, and then relay, the state of that thing to some internet server somewhere. So there's a whole kind of category of radio waves that are actually very good for these use cases, called LoRaWAN. And these radio waves are super long distance, super low power, but have very low data rates. And so the Helium team started in 2013 trying to popularize this concept. And they built all the wireless stuff. It all worked really well. What they realized as they tried to scale the business was that they didn't have $5 billion to go become a nationwide telecom. And so they kind of came up with this idea of saying, hey, what if we can create this crypto blockchain network? And what if we can incentivize rational people all over the country and all over the world to just buy a little hotspot, plug it into the wall at home, create radio waves, and then charge people basically per byte of data for using the network. And so that's what Helium is. It's a new business model for deploying wireless networks, the first iteration of which is focused on these low-power IoT devices. The network went live in August of 2019. And today there's about 9,000 hotspots all over the United States that are running, covering something like 75 or 80% of the US population is covered today. And there's now about 100,000 IoT devices connecting to the network and submitting data every day. And that number is growing pretty quickly.
Do you have an estimate of the number of devices that would want to receive LoRaWAN transmissions? Like what's the kind of addressable market there? I'm trying to figure out what that network is suitable for.
Yeah, so I mean, the answer is we really don't know. Like, this is largely a new market. For anyone who's like followed IoT or dug into IoT over the last 6 or 7 years, you've seen all these very bold promises about like smart cities and smart globe and all these things. For any of that smart stuff to work, the like key input is a sensor that detects the current state of the world, whether that's the temperature or the humidity or the location or whatever. And so the problem with all of these like big, bold IoT initiatives has been, how do you blanket the entire nation or the world in radio waves that are good for devices that need to have very small batteries and very long battery life, right? Because like you can't have people changing these batteries every 24 hours. It's just too expensive. And so that's always been like the fundamental problem. And Helium, is really today the first large-scale LoRaWAN network that's ever existed. It's just never been economical to roll such a network out. So now that the network is starting to exist, it's really been the last 4 or 5 months that serious companies have started to look at this and say, hey, we can actually build our business on top of this. So like, for example, Lime Scooters is now doing all kinds of work with the Helium network. There's about another dozen or maybe 24 Fortune 500 companies that are now working with Helium on integrating the LoRaWAN system into their various business practices. If you go to helium.com/use, they have all the publicly disclosed customers are listed there today.
The individuals that are buying the hotspots, are they doing it out of an expectation of actually turning a profit, or is it just for the thrill of kind of participating in this network?
I would say it's both. So the first round of people, folks like ourselves, for example, thought it was just really cool, and there's a pretty large niche of geeks out there who are like IoT geeks who just like think this stuff is cool. But like, in order to get from we have 9,000 hotspots today, like I would love there to be 1 million hotspots all over the world, and in order to get to that level of scale, you have to be purely economically motivated. And so the key to doing that is to have the price of HNT go higher and have the cost of hardware go lower.
I guess the revenue that you can expect from buying a Helium hotspot is heterogeneous based on maybe where you install it and the usage characteristics of that location, right? So you're not necessarily earning the same thing, indiscriminate of your location, right?
Correct. So if you think about, again, like deploying a wireless network, there's like two distinct forms of value being created. One is I am on the network right now transmitting data, and obviously that's creating some value for me. And then the other is I know I have the option that if I travel to any of the other places, I will be able to transmit data there. And so those are two distinct forms of value. And if you think about like, how do we incentivize people all over the world to deploy these things, right? We want to have coverage, even if in places where usage is 1/100th or 1/1000th the median location. And so the algorithm for HNT is mined much like Bitcoin. There is some determination made by humans of like what percentage of rewards should go to people who are actively transmitting data versus people who are providing coverage that may not be utilized at the current moment. That is kind of a fundamentally subjective trade-off. and governance rights in the Helium network will, I'm sure, adjust that over time.
And would you say the users are actually earning return on their hotspots, or is it still an expectation of the network obtaining future use?
Yeah, so the Helium network mines 5 million tokens per month. That's just embedded in the protocol. So there's something like 70 million Helium tokens outstanding today. Helium trades on Binance.com and on FTX.com today. I think the price is like $1.80 or something. So there's a real market cap here for this to work with. And if you are mining HNT with a hotspot, you can definitely go sell it and make dollars.
So the model here is interesting, the token model, that is. So you have this continuous issuance in terms of rewarding the network participants. And then there's also the other end of the network is constricting as there's actual usage, as kind of enterprise clients utilize the network resources, right? So tell me a little bit about that.
Yeah, so we helped the Helium team kind of design their token system. And one thing we realized early on was that wireless data is a commodity, fundamentally is a commodity. In the same way that you pull oil out of the ground and it's a commodity. And now it's a different kind of commodity in that, if you don't use data last second, it's no longer useful this second. But there's obviously some fixed bandwidth there's some fixed amount of bandwidth available at any moment in time that can be consumed. So the way that we thought about this was that we wanted this to actually be useful, and this network clearly provides some obvious utility, which is relaying data between point A and point B. And so we thought the best way to design the token network was to actually make HNT into a commodity. So the system prints 5 million tokens per month, regardless of anything happening. In the same way that you can just imagine oil shooting out of the ground. Obviously, the people who set up hotspots earlier have been rewarded more proportionally, which again I think is pretty equitable. And then the flip side is as people use the network. So I'll just use Lime scooters as an example. So Lime, if they've got scooters, they want to broadcast the data with these things. They have to pay per byte of data. I don't remember what the price per byte is. Let's just say it's a tenth of a penny per megabyte for simplicity. So if they want to transmit a megabyte of data, they basically have to buy that amount of HNT, and then they have to burn that HNT. They actually light it on fire and destroy it, and by doing that, they basically earn the right to receive get the data broadcast from somewhere in the real world to Lime servers. And so by doing that, basically there's always this downward supply pressure as more and more companies are buying and burning HNT. Meanwhile, the network is always printing new HNT at a rate of 5 million per month. The system does have an oracle in it. So there's something like 15 or 20 nodes that are grabbing the price of HNT USD, I think every 24 hours, and relaying that to the network. And so that ratio determines the number of HNT you need to burn, or the amount of HNT you need to burn in order to produce a single data credit for, let's say, one megabyte of data. And that's kind of how the system is mediated.
So unlike, the kind of utility token idea, a unit of HNT is actually redeemable for a real world kind of computational network resource.
Yes.
Yeah. Did you draw inspiration from any of their projects, or would you say this is kind of the first of its kind in that respect?
Yeah, so we definitely drew on inspiration from a lot of other networks. The one actually that I think had the most amount of inspiration was Factom. The Factom network had a similar idea where it was saying, look, you want to embed data into this blockchain and anchor it here forever. There's real economic value to that. And they had an idea, they called them entry credits, but it was a similar idea, basically pegging the Factom USD price and having a conversion ratio between the two, have it be a one-way conversion, have the entry credits be non-tradable and non-redeemable and non-transferable, so that you don't want a secondary market for these things. You want ultimately the enterprise customers here to not have crypto on their balance sheet that's speculating in value. You want them to just think they're buying AWS credits or something equivalent to that. So we drew a lot of inspiration from Factom on a lot of those core ideas.
So zooming out a little bit, I mean, we've talked about a couple live kind of quote unquote Web3 projects that are, functioning today. I mean, it seems like we've come a long way in Web3 in the last couple of years. What would you say in the next 2 to 3 years? What's it going to look like? I mean, what can we expect? Are we going to get this beautiful utopia where everyone owns their own data and their own identity, and we have this completely serverless model where we're not dependent on these internet silos anymore? I mean, what do you expect there?
Yeah, so I think the own your own data thing is still pretty far away. I think that the first class of those applications will probably not be feature parity with Web 2 for still probably another 3 or 4 years. I think we still have a little ways to go for messaging apps and chat apps and photo sharing apps and those things. There's a lot of harder problems with whenever you want to do sharing while also like managing keys and like who has access to them. Those problems become just exponentially more complicated. The first class of applications that you will start to see happening now are things that can leverage truly public infrastructure. So Audius is a great example. Audius, nothing is private, right? The point of the system is that all the audio files are completely open. I think we'll see a large class of those kinds of applications. So you could say media broadly falls into this category of people who create stuff. They want to share that stuff with the world. They want to have a direct relationship with the customers or consumers of that content, and they don't want to have any platform risk or be intermediated by middlemen of some form. So, after music, the kind of next obvious class here is probably just like email newsletters. A lot of people today rely on Medium and Substack, right, for distribution. And there are obviously good services, but there's a lot of kind of platform risk and people complaining about those actually quite a bit. So like, I think I know for a fact we're going to see a handful of people committing in that space pretty soon, and they'll be able to deliver, consumer grade Web 2 experiences that have maintained Web 3 properties, trust properties in the next probably 6 months or so. And then it'll probably be more public domain stuff. Getting into the element of private domain stuff that runs on public Web3 infrastructure is just that's further away.
Yeah, the content delivery model that we have now seems, we're both content creators. To me, it seems irreparably broken, and I'm actually shocked that we haven't seen more innovation in terms of decentralized mediums or selective paywall unlocking for internet content, as opposed to forcing everyone through this credit card subscription model online, which is the main way we consume content. I'm actually shocked it hasn't happened yet, but optimistic that we kind of get there in the near future.
Yeah, right. And you can see that the right number of things are just starting to hit critical mass. So like Brave is about to cross 20 million monthly active users. And the Brave guys, they're thinking hard about crypto. Like they know crypto is going to be a big deal and they're figuring out what to do with it. You'll see the first, crypto native publication platforms proliferate over the next 12 months. I think those things will start to intersect with each other in some pretty cool ways. And I think once you have a couple of at some point you're going to get some famous artist or writer or something is going to like publicly endorse one of these things, and it's just going to like light a match under that kind of whole industry, and it'll just start moving really fast. So I feel pretty good there that all that stuff's going to happen. Where does that evolve into is murkier. But I think once you've got some high profile consumers endorsing this stuff and saying, look, like it's great and everyone loves it, that's going to really accelerate all the Web3 stuff.
So maybe to wrap and put a cap on this. So, historically Web3 was very tightly intertwined with the Ethereum story as like one of the key value propositions of Ethereum. Maybe today slightly less so. So I guess my question is, does Web3 depend on the success of Ethereum? And then also conversely, does Ethereum require the success of Web3?
I think the answer to both those questions is no. in order for any of these Web3 things to work, the reason they're relevant to blockchains is you need some sort of logically centralized coordination point for all the systems to work. So Audius is actually an instructive example here, where you just, if you want to have recommendations and curation and social profiles and all that stuff, right? Like you need a place to put all of that information. And if the system is open and decentralized, then you need some sort of credibly neutral, politically neutral, open database. Turns out blockchains are kind of the first instantiation of that. So there's nothing about Web3 is tied to Ethereum and the EVM. It just, Ethereum happened to be the first, openly programmable database thing. But there's going to be, in fact, there are already many others. So I expect to see the majority of Web3 stuff happen elsewhere. For example, Helium actually is its own blockchain because they determined Ethereum would not support their scaling needs. And I think you'll see a lot more of that in the pretty near future.
Well, Kyle, you are a pretty visible person, so I think people know where to find you, but maybe just remind us, how should people follow you?
Yeah, so I am on Twitter at my name, so at Kyle Samani. Pretty easy to find me there. We also have a blog. We like to write stuff. I don't write quite as frequently as you do, Nick, but I like to think that I'm still an active writer. And so all of our written content is on multicoin.capital.
Well, thanks so much for coming on, Kyle. It's been a pleasure.
Hey, Nick, this was super fun. These are all kind of wacky, weird things. So glad to have a chance to share with the Castle Island audience.